Our stance remains pro-risk and short volatility in the first half of this year, but we expect to reverse that progressively as we move through the second half. Our proprietary global leading indicators suggest that the worst of the global slowdown is behind us, but any immediate improvement will likely be modest. Much more importantly, though, is that financial conditions both in developing and emerging economies have continued to improve and global money supply to accelerate, particularly US M3, and it was the acceleration of the latter last year, together with the Fed's reversal of QT and resumption of stealth QE in the autumn, that turned us much more positive again on risk assets and equities in particular. Now, although we actually ironically expect that US growth and in particular wage growth may err on the downside versus consensus over the next few months, conversely, in the second half of the year, given the Fed's preemptive liquidity injections and the resultant yield curve steepening, we think both growth and US GDP growth and wage growth could surprise on the upside in the second half. Should we indeed see this acceleration in wage growth in the second half of the year, it may induce US companies to accelerate capex intentions sooner rather than later, and create the late cycle boom which had been previously cut short by the trade war in Q4 2018. On the other hand, faster wage growth and a new round of fiscal stimulus may present the Fed's new symmetric high inflation policy with challenges come late 2020 as the Fed no longer finds itself pushing on a string as headwinds turn to tailwinds. We expect the US-China trade truce to last until the elections, even though the actual deal may disappoint in terms of the rollback of tariffs. This leaves us, as before, tactically positive but strategically negative, as the deal clearly does not address the major issues of trade friction, notably China's industrial strategy policy and its data protectionist ones. So the enduring struggle between the superpowers for hegemonic mastery will continue for the indefinite future, and this lies behind our concern of a new theme of global fractures, which in turn in the long term will probably cap valuations, all else being equal. In the shorter term, in China, the monetary transmission mechanism is being hampered by conflicting objectives of dealing with moral hazard, but also moving to more market-directed lending rates. At the same time, with corporate defaults increasing and corporate spreads widening, banks are themselves turning more risk-averse on top of their own capital constraints. In response to this, poorly resourced local governments are being asked to deal with these funding stresses, so that yet again it would appear that fiscal stimulus will have to come to the rescue, although the emphasis will be on infrastructure rather than property. 2020's GDP growth target has been set at 6%, and in the short term, with PPI deflationary pressures abating and the front-loading of fiscal stimulus, together with the relaxation of shadow banking activities, growth may show some better numbers over the spring. However, the new policy mandate of stability first and so-called scientific stimulus suggests that should growth overshoot the 6% level, the authorities will move quickly to moderate that. The key point then is that this year, very uncharacteristically, Chinese import growth will be negative, and thus, as we have argued for some time, unlike 2009-10 and 2016-17, China will not choose to reflate and rescue the rest of the world. The Eurozone remains heavily polarised, with Germany and Italy bouncing along the bottom and France and Spain relatively buoyant. However, given its overall sensitivity to global demand and particular China trade, there's no sign of any imminent acceleration in growth. And indeed, German manufacturing capex remains under significant pressure, with particularly the auto industry facing structural headwinds and the output PMI for manufacturing in deflationary territory. On the other hand, consumption, services and construction are offsetting the manufacturing downturn. In contrast, in the UK, Boris Johnson's stonking victory suggests a smoother 2020, although predictably the challenge of agreeing a free trade deal by the end of the year has led to fears again of a hard Brexit and hence, as we anticipated, a drift downwards in sterling. But unlike the Eurozone, where we suspect any fiscal stimulus will prove to be too little too late, sensibly targeted fiscal stimulus in the UK could yet prove a major positive catalyst for both the economy and markets. The outlook for emerging economies and markets has become more patchy as the benign disinflationary backdrop has begun to dissipate, leading to a pause in the previous monetary easing cycle. However, the US-China trade truce and the Fed's liquidity injections are broadly positive for equities. The two areas that we would particularly highlight for potential positive surprises are Russia and Brazil. In Russia, despite the significant outperformance last year, both fundamentals and valuations remain attractive, and Ukrainian tensions appear to be improving. The one tail risk would be some sort of resumption of a threat of exacerbated US sanctions as a fallout from the Iran-Iraq flare-up. In Brazil, with core inflation well below target and extraordinarily low interest rates, we should see a significant acceleration in GDP growth led by consumption and housing, and then latterly investment. Perhaps even more interestingly, with interest rates at unprecedentedly low levels, domestic investors are increasingly being forced out of their traditional fixed income investments into equities and properties. And this trend should accelerate over the next few years as around 54% of debt starts to mature, a lot of which was originally issued at 14% levels. So in conclusion, although markets are getting a little bit ahead of themselves and valuations somewhat stretched, we would use any pullback as an opportunity to buy the dips. It's almost impossible to handicap how the recent Middle East flare-up will play out, but unless it leads to an oil price sustainably above $85 and hence a global recession, we don't see that as a strategic threat to markets at this point. So in conclusion, we will remain pro-risk and use low volatility in the first half of the year as an opportunity to hedge the risk of greater volatility and choppier markets in the second half.